You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. How are you doing? Finally, we're going to talk about Bell versus Telus. It's been a week that I thought I would do this podcast. And finally, this morning, Telus reported their earnings. So I spent my morning going into that. I do have a lot of more digging to do for my video that will happen next Thursday. So on May the 16th, it will be a video on Bell versus Telus, digging a little bit more on the financial statements, showing you some graphs. So obviously you have like the visual support. So if you don't want to miss it, subscribe to my channel on YouTube. So just look for the Dividend guy on YouTube and you'll find me there. But now let's get on to the numbers and see what's going on with both companies. As my kind of like my first thought, I'll have like more to present next week for sure. So Bell reported last week and it wasn't a good quarter. The company struggles to generate revenue growth. So revenue were down 0.7%. So like, let's say down 1%, mostly driven by a decline in Bell Media. So of course, wireless wireline, actually, they kind of like reported good news in a sense where revenues were pretty much stagnating, but on the good side of things, they were getting more people on board. So they were signing more contracts, getting more people offering their services. So that's great. But that was like not enough to drive the revenue into growth mode. Where it bugs me a little bit more, and this is where the bad news starts, earnings per share, adjusted earnings per share were down 15%. That was mostly due to a lot of factors, actually. Most like one of the biggest one though, and it's something that we already knew that was coming. It's the fact that they did major layoffs. So when you lay off employees, you have to pay them for a while. You have to pay severance packages as well. And of course, while it's going to be good financially speaking for the long term, right now we don't feel the impact of those layoffs into like the earnings. Well, actually we see them negatively. Eventually we should see them on the positive side. It should also improve the cash flow because you're paying less employees. But right now, since most of them are still getting paid and they're still getting like those packages, it is not helping. Another thing that is not helping earnings and not helping cash flow, you probably guessed it, interest charges. So interest charges increased by 72 million or 21%. So this is also another dent in the ability of the company to generate cash flow. So long story short, not a good quarter about that. When you're thinking that you see that the cash flow are not growing, actually cash flow from operating activities were down 9%. So even if the company reduce its capital expenditure, so spending in their projects by 8%, we see a free cash flow that was flat for the quarter. And the free cash flow was not enough to cover the dividend. So what's coming up is probably a little bit more debt to finance CapEx and the dividend at the same time. And that means that these interest charges will continue to increase. Another factor to consider here, which is super important, is also the fact that even if we have interest rate cuts in the second half of 24, which is pretty much obvious, this is what we're going to get, Bell is still going to renew existing debt, renegotiate existing debt at a higher rate. Even if we have like a small rate decrease, it's not going to be enough. And for 2024, for the guidance, they expect actually that the free cash flow should decline by 3 to 11%. So that's their most recent guidance. Free cash flow decline. This means that the business is not going to grow this year and will be in a tougher position, tighter position with its budget to pay a dividend next year. And at one point, I don't know, like even management is getting a bit evasive on what's going to happen with the dividend going forward. and they're just getting into more debt. So long story short, I don't really like what I see right now. There is a silver lining though. They are still growing their wireline wireless business, and after all those layoffs, they could pull it up and put back their financial statements on board for 25. Again, I keep my eyes on operating cash flow, capex, and free cash flow. I need to see operating cash flow and free cash flow to increase. This is not going to likely to happen in 24. So this, like, if you have BCE in your portfolio, I feel your pain. It's probably a very difficult situation that you are in. And there's no clear answer here, because if they can turn that situation around, it will come as a good investment. But right now, it's not looking that great. That's just my 2 cents. I mean, you do whatever you want with that, right? For Telus now, I mean, Telus was a little bit better than Bell, but I was not like jumping all around and cheering after I read the financial statements this morning. Revenue down as well, 0.6%. So similar to Bell, we're like down 1%. Similar story here. Again, the wireless wireline services known as Telus Technology Solutions, that revenue segment was up by 0.4. So, I mean, we're not going to go crazy about that. But the reason why the entire business revenue was down is because all the other supposedly growth vectors, and this is what I like about this business, but it's not playing out in its favor right now. So we're talking about Telus Health, Agriculture, and Telus International. Well, they were, like, the revenue were down minus 0.7%. minus 2.4 and minus 9.8% respectively. So not a great quarter here. Again, Telus International down almost 10% revenue, mostly because their clients are spending less than they used to. Kind of have like that feeling that the economy is waiting on them as well, but it's not helping the company that much. In terms of cash flow from operating activities, it was better. So 950 million, up almost 25%. The capex was relatively stable, up 1.7%. But unfortunately, the free cash flow was down to 396 million. So down 26%. Like, again, a little bit better than Bell. The company reaffirmed its guidance for 2024, expecting capex of 2.6 billion, expecting adjusted EBITDA growth by 2 to 4%. So like, the operating revenue 2 to 4, adjusted EBITDA 5.5 to 7.5%, and free cash flow of 2.3 billion, which would be enough to cover the dividend. When we go a little bit deep inside their financial statements, they explain that they have a target for their payout ratio. So the target is between 60 to 75% of free cash flow. And they explain that as of March 31st, 2024, the ratio was at 91%. So there's still room to pay the dividend and to continue to pay the business. The debt should not increase, which is a good thing. But again, we are not out of the woods. So the numbers are slightly better, but I was not overly happy. The company is also facing similar problems with the debt. So interest charges went from 320 million to 394. So it's up 23%. Similar kind of increase than what we saw at Bell. So this will also be a problem for Telus going forward. And the key here for Telus is they're doing a little bit better for cash flow, which is a good thing. But they will also slow down their dividend growth going forward. I don't expect them. I mean, their target was to grow by 7 to 10% per year through 2025. Not necessarily convinced that we're going to get that at this point. I'm still in a wait and see mode to see the next quarter. For this one, it's enough for me to keep me waiting because I have Telus in my portfolio. So it's enough for me to keep me waiting a little bit, but I'm not overly optimistic at this point. I am really in a position where I expect Telus to turn things around, mostly because they have several other like business segments that should eventually bring more growth. Health, agriculture, and Telus International, there's still a lot of potential over there. The wireless business is still doing well, similar to Bell. So it's all a matter of making sure that they can turn their business around. So you see, this is a classic case where diversification is key. So yes, Telus is in my portfolio. Yes, it's not a big performer right now, but I have other stocks that can compensate, and this is what is the beauty about having several companies in different sectors. So right now, I'm not super happy with Telus. I am not ready to throw the towels yet, but of course, it will require more monitoring in the coming months. So right, Moose, you're going to get more details once again on my YouTube channel next week, more graphs, more digging, but today I have to let you go. You probably heard my dogs that were not too happy about the earnings as well, so they're whining in the background saying like, Telus and Bell, they're not doing great, what's going on? So I'm gonna leave you to that. I'm gonna take care of my dogs, and we're gonna talk again tomorrow for Business Friday. So all right guys, take good care, and we're gonna talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.